Hi, in this lecture, we're going to talk about settlement price, positions, speculation, and hedging using for futures. So, first, settlement price. This is similar to the closing prices of stocks on an exchange, just that the price in is generally an average of the prices of the trades during the last period of trading of futures. Now, this reduces the opportunity for manipulation of the settlement price. The settlement price is used to calculate daily gain or loss at the end of each trading day. So, now that we have a fair understanding of futures in terms of what they are, how they are similar or different from forwards, it's good for us to get into the details as to how futures can be used in terms of speculation, hedging, what are the intricacies, which we will also cover in another lecture. For now, a buyer of a futures contract is said to have a long position. Why? The buyer of the future expects the price of the underlying should go up. Otherwise, there's no point in buying, because when the price of the underlying goes up, he makes a gain. And that's why any person who bets on something to go up is the person who's taking a long position. He's bullish. Next is the seller is the one to take the short position. Now he's thinking that tomorrow, if the price of the security goes down, I want to make that gain so that I can sell it at a much better price. That's what. So he's bearish. He wants the price to go down. That's why he's on a short position. So that's what the long agrees to buy the underlying asset. The short agrees to sell the underlying asset. So the speculators are those folks who like to gain exposure to make returns based on their estimation on the future movement of the price of the underlying. So what does that mean? They want to take risks. They are those guys who wish to make risks when they take risks so that they make such gains without having any existing exposure. What does exposure mean? Exposure means exposure to price risk. That is, if you hold an asset, if the price of the asset goes down, you are exposed to downward risk of prices. So these guys don't have any assets. All they are trying to do is use derivatives such as futures to gain that exposure and make a profit or loss based on how they expect the price of the underlying to go. Next is hedgers are those guys who look to mitigate risks from existing exposure to price fluctuation by buying forwards and futures. So there's a bit of a typo there. It should have been futures in this case. So that's what. So now we have a good understanding of what people do with futures. They either speculate or they hedge. And how do they speculate or hedge? They expect if they have an existing exposure, they try to cover that. If they want, in case of speculation, if they want to make a gain or a loss based on an assumption or a gut feeling that they have, they go and speculate. Well, that's it about this lecture. Thanks for watching. I'll catch you in the next. Bye for now.